Lately, the term angel tax has been in the news quite a lot. So today, I am here to decode this term for you. So first and foremost, the question, what is angel investment? Business angel investors are high net worth individuals who usually provide smaller amounts of finance at an earlier stage that many venture capital funds are able to invest. They are increasingly investing alongside seed venture capital funds. Angels usually contribute much more than pure cash. They often have industry knowledge and contacts that they pass on to entrepreneurs. Angels will often take non-executive board positions in the companies in which they invest. In simple words, an angel investor, also known as a business angel, is an affluent individual who provides capital for business startup, usually in exchange for convertible debt or ownership equity. So the second question, what is angel tax? Angel tax is a term used to refer to the income tax payable on capital raised by unlisted companies via issue of shares where the share price is seen in excess of the fair market value of the shares sold. The excess realization is treated as income and taxed accordingly. The tax was introduced in the 2012 Union Budget by the then Finance Minister Pranab Mukherjee to arrest laundering of funds. It has come to be called angel tax since it largely impacts angel investments in startups. Simply put, the angel tax is a 30.9% tax levied on investments made by external investors in startups or companies. To clarify, the entire investment is not taxed. Only the amount that is considered above fair value valuations of the startup, classified as income from other sources in the Income Tax Act of India, is taxed. So what exactly is the motive of angel tax? Black money is the biggest problem that India is facing. Also, out of the large population, only a few people are doing the tax compliance. Presently, around 2% of the population pay income tax and do their compliances properly. Thus, the tax department is worried if they support angel investment, which will in turn increase cases of money laundering. Mostly the startups have their assets which are off the book of the company, which the investors are aware of. As such, they provide them with high valuations. In this situation, the startups defend themselves by saying that by obtaining higher valuations, they do not become an offender and it is not a crime. Also, they believe that they are not involved in any kind of money laundering, nor are they involved in any case of tax evasions. Due to these flaws, the tax department is of the view that the valuation of the startups companies has to be done by the specialists, which is to be based on the predefined formula. Now, this will enable to calculate the valuation of the assets of the startups on the fair value basis. However, if the value exceeds the fair value, then it will be subject to the highest level of taxation. So what are the benefits of angel investment to certified innovative startups? The Government of India has introduced this concept of certified innovative startup, which basically is a startup which has received certification as per which they are not subject to draconian angel tax, which is torturing the startups and killing genuine innovation. Thus, getting a certification is not an easy task. The startups have to follow certain stringent parameters to get the certification. For example, a company willing to apply for certification must follow the following 3 conditions. First, not have a turnover exceeding 25 million rupees. Second, the startup should not be older than 5 years. And third, the startup should be engaged in the production of innovative product or services. However, the parameters set are very subjective. Also, various departments in India are also known for corrupt officers who manipulate the startups, as such startups are reluctant to apply for the certification. Now, where does the problem lay? Angel tax was problematic for a few reasons. For one, valuing startups based on their assets alone, given intangible such as goodwill, is not easy. Nor is it easy to arrive at a fair value for them based on discounted cash flows. So startups are often valued subjectively, and the valuation which seems sky high to some may be fair to others. 2. Higher valuation when raising funds are beneficial to founders, as it means giving up less equity. But given the close nature of these deals, there were concerns on whether there was creative financial planning happening. The tax was introduced as an anti-abuse provision in the 2012 budget to curb attempts to launder undisclosed income. Now, the relaxation could signal the willingness to nurture innovative firms. And thirdly, as opposed to the idea of taxing angel investors, investors in countries such as US are actually offered tax benefits when they fund small companies. There are also ways for angel investors to save tax by reinvesting gains from one small business into another venture. But in India, there was an element of suspicion over startup investments. Attempts to simplify the tax treatment are hence welcome. If you like our video, do share this video with your friends and do subscribe to our channel as well, and do comment in this comment section below because your opinions do matter.